We'll give just a minute or two more, and I know we have a couple more board members that were going to join us today, and Dr. Haskin as well. So we'll give just a minute. They may have gotten caught up with something. Okay, well, we'll go ahead and get started, and hopefully these others that wanted to join us will catch up when they get on. I'm Melissa Langhennig, Personnel Administrator for the city, for those of you that were just meeting. Our committee members that are with us today are Larry Vaden, Debbie Nolte, Director Terry Peavy, and Director Linda Teeters. Kenny is the other board member currently serving on this committee. Director Peavy and Director Teeters, we want to say thank you, because I guess this will be our last meeting with y'all, but thank you for your service, and not only on this committee, but just to the city and to our staff. Y'all are going to be missed.
Thank you. Appreciate that. Appreciate it. I'm gonna miss you guys too.
Yeah, y'all have been friends to us for sure, and we appreciate your service. We have a quorum present, so we'll go ahead and move on item number 2 on your agenda, which was to approve the minutes from our last meeting. Those were sent out ahead of time. I hope everybody received those. Were there any comments, anything that anyone wanted to address from those minutes? Okay, can I get a motion to approve the minutes from 10/23/2019?
Make a motion.
All right, and may I have a second? All right, Director Teeters. All in favor?
Aye.
Any nays? All right. So the minutes from the 10/23/2019 meeting are approved. All right, let's welcome our other guests on the chat today. Tom Bevins is the consultant actuary with GRS Consulting. Is that your correct title, Tom? Consultant?
Yes. Yes.
Okay. And he's joined by Danny White, who is the senior consultant, I believe, with GRS. They will be making the first presentation today, and then followed by Bo Brister, who is Senior Vice President of Stevens, Inc. So we're looking forward to hearing what these gentlemen have to say, and we'll kick it over to you, Tom.
Are you ready for us to start? I'm sorry, Melissa.
Yes, sir.
Okay.
Whenever you're ready.
Well, first we wanted to introduce Lindsay. She's been part of our team for a while, and in the background doing some stuff. And so we wanted you guys to get to meet her, and know that she does a lot of the work behind the scenes as well. So, having said that, as you know, Danny from previous years, I think he had a last year. So what we do again is we do try to take a snapshot look at the valuation plan, and that is what our actuarial valuation is. Things are constantly moving, things are changing, but again, we try to take that measurement to kind of see where we're going from where we've been, and again where we're looking forward as well. It's really the most important thing. So if you look at this page 2, the summary of the valuation results, in general, which was not, was common among all plans, pension plans, was that as of a June 30th, 2020 date, that wasn't great from where the assets were. And obviously they have, been climbing back. But that was obviously not a great day to measure that amount. Having said that, as of a year, it's a negative 1.2 return. And we're comparing that to our assumption of 6%. And are you guys getting feedback?
Hey, Tom, you may want to ask
Try this.
It'll help everything.
That's not working either.
There it is. That's good.
Yeah.
That's better? Okay. Yeah, I think we were trying to use a speaker to amplify, but I think that was causing the feedback. But one thing we've done, and this will be discussed later, is, when we look at where the assets are, where the plan is, it's very mature, it's a closed plan. Based on the plan's investment policy and the current actual allocation, that 6% that we've been using is just something that really can't be justified when looking at prospective capital market assumptions. And so this valuation does have a change in that we are now expecting 5% rather than 6%. And that does increase the liability, and it does decrease the projected amount of time which the plan will be solvent, because of that increase, again, to the liability and less expectation in investment returns. As you can see there, basically with that measurement is, the plan had 233,000 less in assets than would have been expected had all those assumptions fell through. On the liability side, again, that's where you can see that number, that just the change in the investment return assumption increases the liability almost $900,000. Now we did do, and this is something we always need to monitor as actuaries, is the mortality table. Tapers is a very small plan, and we can't really rely on its own experience. And what we've done in the past is we've kind of used the fact that Texarkana, Arkansas is a sister city in Texas as part of the Texas Municipal Retirement System, and we used the assumptions that they use. And they recently did an experience study, and so we updated the assumptions to just be in line with that as we have in the past. And this is just routine maintenance on that end.
I'm sorry, I couldn't hear him at all. Melissa?
Of those that includes the investment returns, the change in mortality is relatively small.
Danny,
Yes, sir. Yes, ma'am.
we're unable to hear you. I'm so sorry.
Okay. Is this better?
Yes, sir.
Thank
Yeah,
you.
to reiterate, we, as actuaries, there are standards of practice we have to adhere to, and those include regarding assumptions used in the actuarial valuation, and with the change in allocation, change in forward-looking expectations. This would be a great, Bo's going to build on this going forward, so I'm not going to dive into it, but it warranted a change in the forward-looking return estimate. Please note that in the mortality change as well, we have to look to somewhere as a valid assumption. Note, while the change in the investment return assumption changes the liability, it really doesn't impact on the liability side the projection of future benefit payments. That has largely remained unchanged from the prior year. And I think that's more of what we're moving into when we get into the val, is more encouragement to cash flow match. That is, have as much contributions coming into the plan as benefit payments are going out. But Tom, I'll turn that back to Tom.
As you can see, the funded ratio is one of those metrics that's kind of a snapshot. The trend in that is what's important to look at. And as you can see, between not attaining the assets, again, as of that date, as expected, and the increases to the liability, the funded ratio decreased, from 44.6% to 34.8%. We've kind of had the same message for years that the plan needs more contributions. I know efforts have been made. We noticed that In calendar year 2020, the increase was from 50,000 a year to $100,000 a year extra on top of the payroll-based contributions. But again, that payroll base is small with 14 people. So, and that piece is only going to shrink. And so we'll get into more of that in a little bit in more detail. We're actually going to slide 3 and ask Lindsay's going to kind of go over some of the demographic changes that went on in the plan.
Hi, can y'all hear me?
Mhm.
Okay. So for the demographic information, there was no change in active participation or retirees and beneficiaries, noting that 7 of the 14 members are currently eligible for unreduced retirement. There were four terminations among transition. 2 of those took lump sums, and the other 2 are inactive with a deferred benefit. And then we have 1 more current inactive, who took a lump sum. So that gets us from the 2019 count of 32 to 2020, 33 inactive participants. Overall, there was an increase of an average pay increase of 3.8%. And then moving down to the contributions, you can see the city increased its contributions from 2019 to 2020. Some of this is due to the increase in the covered payroll. And then, like Tom was saying, some of it is because the city increased their annual appropriations from 50 to a rate of 100,000 per year in calendar year 2020. So those combined increase the employer contributions. You can see there's a lot more money coming out of the plan. Benefit distribution amount at for 2020 shows $478,000. It's also worth noting almost $100,000 of that came from the lump sum.
Could we see those statistics, Lindsay? Are they up? Or we see those statistics?
Now, so we're sorry, we're getting a little feedback again.
Lindsay, are they up? Yes, I just asked if we could see those statistics while you're talking. Could you put them up on the board?
We don't really have that available to post to you in terms of that.
Okay.
But there is something we can show you in terms of, are you talking about statistics in terms of the actual lump sums paid and the contributions, or?
Well, just, yes, I just kind of visual. Yes, I need something to look at while she's talking.
Okay. Well, I mean, in terms of the individual amounts, I mean, do you have a copy of this, by the way?
I didn't print that out, no.
Okay. Yeah, I'm sorry. We tried to project it behind us is what we had, but maybe you couldn't see it well enough. And so I don't know if it'll help. Yeah, go ahead, Dan.
Director Peavy, if you'll give me just a moment, I might be able to share the presentation on my screen. You just won't be able to see the people that are speaking at the moment, but you'll be able to see the presentation. Will that work?
Absolutely.
Okay,
Thank
give
you.
me
Thank you, Tyrone.
just a little bit and I'll try to catch up with you.
Lindsay, while she's getting that on the screen for us, did you say the numbers went from 39 to 23 on who's still on the plan?
I'm sorry, could you repeat that?
Did you say that the numbers went from 39 to 23? Who's still on?
She was referring to the inactive participants when she said.
The inactive.
Yeah. Overall, the plan went from 97 to 94. The most important people in the plan are the actives and the current retirees and beneficiaries, and none of that changed. And the current retirees and none of that changed.
Okay. 97 to 94 active. Okay.
Yeah, she was kind of just going through the basic movement of the plan, and most of it was with transition participants, which have very little liability in the plan.
All right.
Yeah, there's one thing, and one part very little. Lindsay, when you were talking, we were getting a lot of feedback and repeat.
Mhm.
Can you mute yourself? I don't know if that's why we're.
It might be. I'm having a lot of lagging too.
Okay. Yeah,
It might
try
help
to-
if I mute.
I don't know if that's the problem. Sorry about that, everybody. Yeah, so moving on, we can probably move to the next one and we can come back to that if you want to see those statistics. And again, or review it with the handout. Danny brought up the idea of the cash flow, and the last thing on the previous slide was basically showing that there's a lot more benefits coming out of the plan than money going into the plan. And if you compare that as one metric is net cash flow as a percentage of the assets. And so for last year, if you compare that to the beginning of the year, it was at negative 10.2. Now, it's common for a mature plan to have a negative cash flow because the idea is the offset of that is the investment return. But if you have a net cash flow that's negative 10%, you're basically saying to break even, you have to earn that 10.2% in your assets. And really, because the plan is mature and there's so many people eligible to retire of the remaining active employees, you need to have some liquidity in your assets, which is why the asset allocation is what it is. And so it's nothing. Bo can't create magic on the market. That's just not at this point a reasonable expectation, which is also why we had to change our assumption on that end. And so as you can see here, when we're on slide 4, those of you that have the presentation, this kind of just shows the basic results. Again, we changed to 5%. The liability grew from 7.63 million to 8.86 million, or 8.66 million. The assets decreased from 3.4 million to just over 3 million. Again, this is as of the valuation date. It's currently as of October 31st. That number is below 3 million. And as we've already noted, the funded ratio. So when you look at that unfunded liability of 5.6 million, that's got to be made up somehow. And those are in the future. We're really talking about if the asset trust becomes depleted, how is the city going to be able to pay those benefit payments? And that's again just why we're again the same message, but just louder because it's sooner and it's we're now getting to that point in time that we've been discussing for several years. So the accounting thing is probably really not a whole lot of importance for this discussion. They are different metrics for different purposes. If you have any questions about it, you're welcome to ask. But in terms of that, the funding basis is really the primary purpose of this discussion. Tyranda gets to really worry about the accounting stuff, right? Moving on to slide 5. Again, this is just now we want to look at what's our future outlook. This kind of just shows the unfunded liability over time, and you can see there's some increases right here. There was a quick dip on the plan change helped because it froze people in the plan, and then there was another dip in the liability and the unfunded liability because there was a lot of people that took lump sums that year. In fact, I don't remember the exact number, but it was significant compared to the assets in there. And then you can see that other big jump. That's the big jump from this last year based on the liability increases due to assumption changes and also the increase of the unfunded based on not getting the return as compared to the expectation of what was 6%. And these projections, we are projecting these results, assuming that $100,000 appropriation stays constant over time. But as we'll see, that more is needed. Moving to slide 6. So the red line, the top line here, well, I could never be a news anchor. I'm doing it backwards. The red line, the top line, the one that starts at the top, moving downward. Oh, here we go. Great. Thank you, Tyrone.
Thank you.
Oh, yay.
Perfect.
Thank you, Tyronda.
You're welcome. Sorry it took me so long. I had to dig through my email and find it.
So now, the red line, as you can see, that's the liability. That's gonna go down over time because there's no new accruals really or little accruals of liability based on the closed plan, and most of those individuals are fully accrued. Not yet, but many of them are fully accrued in their benefits. Now the green line, the middle line, that's what we're saying. If we, if the plan can get the extra $490,000 again, so that's 390 on top of the 100 already being contributed, that's kind of the outlook there. And you can see where those two intersect. That's when the plan becomes fully funded, or a funded ratio of 100%. And then from there on out, then we can kind of just taper off the allocations and kind of let it work itself out. But with just 100, you can see there it's going at a pretty steep decline. It looks like it actually hits the line at 2029, and we say that it'll be depleted in 2028, meaning the plan year beginning July 1, 2028. So sometime in that time period until we get to 2029 or July of 2029 is where we're saying that our projections, if all assumptions, meet exactly, which we know they never do exactly, but that's, as of now, according to those assumptions, is where that would be depleted. Now, I'm moving to slide 7. I'm sorry, was there a question?
I had one question.
Yes.
Based right now on the age of the participants that are in the plan, how many
Yes.
employees are we looking at still having on the plan in 2029?
I don't have that number in front of us now. What we do is I can tell you this, of the 14 people, and Lindsay, I think, said this, 7 are eligible today to retire as of, with completely unreduced benefits. So if those people decide, they can. Now, those are based on assumptions, that outlook. In 9 years, I would think that everyone, or not everyone, most people are going to be eligible to retire. So I guess as a general estimate, I would say
They'd be eligible.
yes, many will be eligible to retire. But I would say probably more than half of the 14 would be eligible by then. And we would project that maybe only half would be left.
Okay. Okay. I guess that's all for now. Okay.
You do have a lump sum optional form of payment, and to the extent that they elect a lump sum, that could be accelerated. Cash is moving.
Can't hear.
Please also keep in mind the plan is a lump sum optional form of payment. To the extent some of these active members elect to take the lump sum, that would potentially delete the assets sooner. Now, on the liability side, the liability gets smaller too.
Right.
So it's kind of a net effect, but it does heighten the sense of, I don't want to call it liquidity. You have plenty of liquidity in the plan, but it's the need for the cash needs to be available.
Right.
This is kind of where we're at now. It's becoming more of a reserve, for benefit payments. And so they just have to have the emphasis that cash flow needs to match, that we need to have more contributions coming in as benefit payments are being paid out.
Yeah, that cash flow metric is very volatile because of the lump sums, as Danny said. So that can change quickly. So now on slide 7. And we showed this last year, and it just kind of shows kind of past and future. If you can kind of tell that there's gray space on the left, that's all past results. And just kind of distinguish here, there's a lot going on. The assets are there in blue in both cases. The dashed line is, in both cases, is before the plan change. And then the unfunded liability is in red in both cases. And again, the dashed version is before the plan change. So again, this is still to illustrate that the plan change was still basically, a necessity. And at the time in which the plan was projected back in 2012, when the plan changed, when it would be depleted in assets, it shows there $18.3 million would be the unfunded liability at that time. So it was expected to be projected out longer, as in terms of a period of time, like to a later date. You can see there in about 2034. However, at that point in time, what you're left with was a lot bigger number. So it's plan change just kind of sped up that process in terms of projecting, the depletion date. But I guess, the remaining balance, if you want to call it that, as Danny just said, the size of the problem is smaller. So again, that's just to show, the impact or effect of the plan change. Just kind of tracking how that worked out. Moving on to slide 8. Again, this is kind of showing. Okay. Oh, can you move to slide 8? Oh, thank you. This is just showing, the difference between current track and what would be different if you have the extra appropriations. So you can see, if you can see the blue line, the one that starts lower, those are the costs. Those are the contributions going in the plan based on the current projections and current appropriations. That big spike, well, that means that there are no longer assets. That's where the plan becomes depleted. And so now you're paying benefit payments directly from the city's other source, wherever that's going to be. And it's not coming out of the trust. And so the dashed green line.
Excuse me, question.
Yes.
Quick question. Tyronda, will that be able to come out of the general fund if we don't increase the payments after 2028? When it's depleted and there's no more money, will the general fund be able to make payments out of the general fund?
With my conversations with the city manager about all the different changes as this will be affected, he's kind of let me know that we will have to take the necessary steps at that time, if they come, in order to make sure that our retirees continue their benefits.
Okay.
Question. If we could somehow increase this, and I'm just making up a number, instead of adding 100, if we change that to 150,000, what would that do to the 2028 projection? Could it push it down close to 10 years? Because by then, most of these people would definitely be retired.
The next couple slides kind of give an illustration of that.
Okay.
And so we'll get to that. We don't have 150, but we have a couple other examples that will help, and you can probably go in between. So yeah, Tyrone, if you'll actually go to the next slide. So these aren't graphs, these are more tables to look at. And so you can kind of see that, but it is somewhere on here, the 2028, you can see it's bold. That's kind of where we're showing where it'd be depleted. So this is a table version of what you just saw on the graph. Now, if you go to one more slide over, you can see that getting to 200 rather than 100 really only extends that a few years to 2031.
So only 3 years.
Yeah, so the timing of that matters. And if Melissa also distributed our projection letter, in that letter also shows the impact of delaying appropriations. Like just by waiting 3 or 4 or 5 years, how much impact that can have on that outlook. So again, even 300, there's still a depletion date, in 16 years. And so, we really need to get over that hump as soon as possible. Again, so, the story is the more the better, and whatever the city can do, will continue to help. But it's very sensitive in that matter that things can, we can have, again, some bad actuarial experience with the plan, and this can get accelerated and get even worse next year. So that's why we want to just reiterate, the sooner the city can put those extra funds in, the better chance it has of surviving longer. And so if you move on to the next slide, really our last slide, kind of wrap it up, as we were just saying, the increase from 50 to 100,000 was helpful. Kind of hung on and covered some of, in terms of a projection, some of those losses that we had, because I think last year we said that with 50,000, it was also going to be depleted in about 2028. And so that kind of offset, that increase offset, like I said, those liability and asset losses.
So,
yes, go ahead.
sorry. So actually the increase from 50 to 100 that we did a couple of years ago didn't decrease or increase the years it was going to happen, because we lost our investments anyway.
Basically, yes. And the increase
It ended up kicking the can down the road, but the date was the same, because we've not saved any money, because we've lost it in other ways with investment.
It looks like in the short term, there might be some truth to it this year, but I think long term, it's a beneficial. You can't ever time the market. I'll let Bo get into that. He's probably got more answers and thoughts around it, but from our perspective, it was not a waste at all.
Oh, I don't mean it was a waste, but I'm just saying we're pumping money into this system, and in the long run, we're not helping the employees when they retire, because the money's still not there.
But it's, what we've got is we got a closed system, a closed group of retirees. You got a promise to them, and
Exactly.
it's just funding, making a funding or a matter to these. We're talking about 94, 14 current active, 14 in transition. We got another handful of retirees, and it's meeting the obligations of the promise that the plan, the city provided.
But could we see that, not knowing what's going to happen, we could put another 100,000 in there, and then we could have another drop in the assets. And so we wouldn't see any benefit at the end as well.
This is Bo, just to be clear.
Accelerate the depletion. So, like Danny said, whatever is getting put in there is not going to waste.
No.
It's helping. So, it's if you had bad experience again and didn't do those extra amount, then that 2028 could easily turn into 2026 real quick.
True. But our benefits we projected 2 years ago, now we're not seeing those come to fruition. We're just kicking it down the road further, unfortunately.
Hey, Tom, can you hear me?
Yes.
Okay. Hey, this is Bo. So just to be clear, so the two largest impacts to the funding status has not been the investments, which don't have any losses to them. It is the lump sum distribution of people leaving the plan and the change of the discount rate down to 5. Would that be accurate?
Those are the largest things. Like I said, our measurement is in comparison to our assumption, and that's kind of key. So right. You can earn.
So what was the monetary impact of reducing the assumed rate of return?
So that was the one that was almost $900,000 to the liability.
Yeah, on the liability.
So it's about almost $1
So
million.
that's just So that's just so you guys know. They're doing important work, and you're seeing actuaries across the country lower expectations. I don't think I've seen one lowered to 5% yet, but that's just based on what they're pulling from third-party vendors for capital market assumptions going forward. Might be, we could have different arguments and aggressive. I can tell you the people who made the capital market assumptions have never been right. Nobody can predict it. It's impossible. But that simple change, that nothing else happened to your plan except for lowering the discount rate, was almost $1 million impact to your plan. And so when you're looking at the things of 100,000, 150,000, whether you kick in, it certainly amplifies that if you weren't to put in, but more or less changes with a click of a mouse have a more detrimental impact. And from the investment side, and I don't want to jump in front of them on this, but you didn't have a negative return last year. You don't have a negative return year to date this year. When you have money that can no longer earn compound interest in the plan because it left of people taking their money out, it's a double hit, right? Because you still owe obligations to the rest of the pensioners who are sitting in the plan, and whether or not anything else happens, that money is going out to pay those benefits.
Mm-hmm.
Right, and because of this,
sorry, Tom.
No, that's okay. We appreciate your input on that, and because one of the reasons we did this is when you look at the plan's investment policy and the actual allocation, it just because of needs of liquidity, because of this, there's a bigger portion of fixed income than say some of your really large statewide plans and things like that are just massive.
But that would be the difference between an open plan and a closed plan, correct?
Right.
Yeah, exactly.
Right. And that pretty much wraps up our end. So, Bo, you're welcome to take over from here. Thank you. Sorry. Oh, yeah. If there's any more, we did have some discussion, but if there are any more questions for us, we're definitely open to those as well.
Well, this is Director Peavy, and I think that COVID has just changed everything with the markets, nothing certain with the low interest, blah, blah, blah. I just think it's changed everything, and it's affected and impacted everyone across the board. And with that in mind, Tyronda, I would like to make a suggestion for next year with that budget, when that budget's looked at, for increasing the contribution from 100,000. It has to be increased from what I am seeing, unless, Linda, you disagree with me.
No, I don't at all. I don't at all. It's got to be funded. That's just,
Yes.
there's no other option.
Please, it's got to be funded.
It's got to be funded.
Yes,
I would
ma'am.
make a recommendation, if you would take that back to the city manager, that we increase it from our 100,000 to an extra 200,000 to make that 300,000.
The plan has always been, since Kenny and I have been working as finance director and city manager, is to incrementally increase that. And so we're taking the opportunity to make increases to that contribution rate.
So did it go up this year?
It was left at $100,000 this year, and we'll look at it again next year.
So we're already locked in for the 2021 budget at 100,000.
We've already approved the 2021 budget at 100,000.
So in go ahead. In 2022, I mean, if the board so chooses, they could add 200 to it at that point.
Yes, ma'am.
But that only extends it out to 2030.
At another 100,000, right, Larry?
Yes, ma'am.
But if we did 200 more,
Extended it out to
300.
if we could do 200 more and extend it to 300, it takes us to 36,
I think
which
so.
most of those would be retired by then.
Yeah, I mean, at the end of the day, you're trying to mitigate the amount that has to come out of the city's general fund at that time and when that happens.
Sure.
Unless you jump into that 490 that we recommend now. Again, we can't even guarantee that gets the job done in the exact period of time. But anything short of that, we're saying there's going to be a depletion date in the future. And so
right. So the only issue is, are we going to pay for it slowly?
I'm sorry,
Right.
go ahead.
Well, that's okay. The only issue is the money's going in there. Or do we want to pay it slowly over the next 5 to 10 years? Or do we want to wait till it's depleted in 2028 or 2030 and then have to have huge payments? And so I agree with Director Peavy completely. We need to get that money in there as quickly as we can so it's not a huge hit to the city all at once.
And you also have to remember that any money in the trust fund has a better chance of earning investment gains.
True. The more we put into it, the more investments we can make. Because like you said, you're compounding interest on more money as opposed to less money.
Tyronda, would it be possible to do a budget amendment and add an extra 50,000 for next year's budget, even though we've approved it?
Yes, ma'am, that certainly is a possibility.
So like
We
you're
asked, yes,
listening,
can we put that on the agenda?
listening to you say increasing it incrementally, maybe that won't be such a shock if we can get that worked in for next year's 2021 budget, increase it another 50,000, and then just keep going up, and then do it incrementally, like you said, Tyronda. And we were all thinking that when I was here in October for the meeting, and the stock market was doing great and our money was doing better, but COVID has hit, and the reality is it's the reality, and it's just left a lot of uncertainty. And so if you could run that by the city manager, Tyronda, we would appreciate it, wouldn't we, Linda?
Yes,
Yes,
ma'am, I
definitely.
certainly will.
Director Teeters and Director Peavy and I could co-sponsor that, to put that on our first meeting in December, if you would, Tyronda.
Okay, I will certainly work on that, and I'll talk to the city manager.
Okay.
Awesome. Thanks so much, girl.
Oh, you're welcome.
I don't know enough about this, but I have one question. If people stay past their retirement date and choose to work more, which I did too, do they stay in Tapers and pay into that the whole time? Or from the time that they retire, then their retirement doesn't go into the new plan, right? They're going to stay in Tapers no matter what.
They'll stay in
Okay.
Tapers until they retire.
Okay. Even when they're past their retirement age. Okay. I just want to make sure.
If
So
they,
anybody paying into it right now is going to continue paying into it until they retire. It'll never go
Correct.
into the new plan.
okay, no matter what age they are. All right.
Okay. All right.
Asked about that.
Well, is there any way that we could, and this may be a stupid question, but is there any way that our retirement could join APERS, which is Arkansas Public Employees?
That's an entirely different situation. APERS is a different plan. And so I'm not sure how that consolidation will work. In fact, I think if I understand correctly, and Tom, correct me if I'm wrong, but in order to do that, you would actually have to stop your contribution into Tapers. Where you're at now is where you would cap out. If anybody is already drawing retirement, they will continue to draw that retirement benefit from the Tapers plan, and basically they would start over from square one in APERS. Tom, is that correct?
Danny, he has a little more.
Yeah, this is one that they would earn what they've earned in Tapers to date, and then going forward, they would earn their benefits in APERS. One of the things, the prior city manager, Mr. Harold Bolt, I remember him looking into it, and one of the concerns, and here's the there's some benefits in APERS, but one of the things that is an implication of it is once you enter Tapers or APERS will tell you what you have to contribute, and the city loses that flexibility, and it will be a lot more than what you're contributing now. And it's a requirement. They will tell you, you've lost that control on funding.
Well, and I hate to hear that, but hearing about the dire situation where we are monetarily, I don't know if that isn't something that needs to be considered, Tyronda.
Well, that's the next plan that we have is called, we have ICMA, and that's what all other employees are in. They're not in a state funded APERS plan. When the split was made in 2012, and Tom, you might have to help me out with a little bit of this, or even Danny, but the people that were vested in Tapers stayed in the Tapers plan. Those that were not vested in Tapers, they were then transferred to ICMA. That's why you have some employees that are in that transition spot. Those are the ones that had a investment in the Tapers plan, but it was not enough to be fully vested. So what they had in there, I'm one of those employees, it stayed in that Tapers plan, and then we started over in ICMA. And so I don't really believe that you can switch the Tapers plan to APERS. And there's a whole lot of other moving pieces that go along with it. And that's why the city at the time didn't move into APERS. They moved into the ICMA plan, and they kept tapers for the employees that were already vested in that plan.
Could you just, the ones of us that are not converted, have both, so to speak? Could the people that don't have both, would that be possible to go into APERS?
I really don't, at this time, I really don't think that that's an option. The city only has one employee that's in APERS, and that is state mandated. Other than that, we don't have any employees in the APERS plan. Now we have employees that are in ICMA plan. And at this time, there's a lot of moving pieces to that. But I don't really think that you could transition your employees from APERS to tapers.
Or tapers to APERS.
Yes, from tapers to APERS. You can't stop, you can't move them from one retirement plan to the next necessarily.
You can't move the money over.
Right. Basically, if I understand correctly, you start over. Those that are in tapers, where they're at in tapers to date, that's where they will stop. And then basically they will have to start over in the APERS plan because they wouldn't be vested in that retirement system.
Okay, so let's take APERS off the board and let's look at your IM, what you were saying. What are the initials, the IM?
ICMA.
ICMA. So you stop the tapers and then you switch them over to the ICMA. Is that possible?
I would say that was something that we would have to explore. But I will be completely honest with you. The employees that are fully vested in the tapers plan, that's a better plan for them to stay in. While one's a defined contribution, the other one's a defined benefit. With ICMA, it doesn't work the same way as the tapers plan works. And the amount of money that they get when they retire, it won't be the same either. There's a reason why those employees were left in the tapers plan and why that plan is closed. It's because of their benefit and to keep them from losing any part of their investment.
All right, well then just hearing this, we're just going to have to, I think the city is just going to have to incrementally keep increasing the contribution.
I do agree.
It will. It is that option of the ICMA is not going to save any cost.
Oh, okay.
A lot of your costs, a lot of your benefits have already been earned. They've been baked into the liability. So stopping things prospectively, most of these that are still earning benefits, they're late career employees. They've earned their retirement benefit, the bulk of the retirement benefit tapers. So stopping it prospectively, moving to ICMA, you still have to pay out what they've earned in tapers. So it doesn't change the equation much.
But Danny, just to clarify, I just want to make sure that we have a thorough understanding that if they were to transition into any other plan, it basically will stop what they've received in tapers and basically they will have to start over from scratch in a plan.
They would, that's correct. And then when they retire, they get A plus B. They get what they've earned in one system plus B, whatever B may be.
And with B, with the possibility that B is going to be more solvent than A.
But you still have to fund for A.
Right.
Yep.
Those employees have earned that money. They're going to get it.
Yep.
It just come out of the city coffers.
That's right.
Because they're locked in at their benefits no matter what the city does.
They're very, very different benefit structures because tapers is a defined benefit plan based on a multiple of your salary, whereas the other plan is a defined contribution. It's just, is it 10%? Is that the contribution? Is it 10? I believe it's 10% of your income, and that's going in. So that takes a little time to build up.
One more question, and I know it's because I know we're closing the program, but isn't it historically you want your employees to take a lump sum because it saves the company money in the long run because you reduce your benefits proportionally when you take a lump sum. The reason we're not seeing it in tapers is it's closed, and so there's not enough money coming in to offset those massive lump sums at one time. Is that what's going on?
Well, the lump sum option, it's, you don't know towards the end whether or not the plan saved money or not. It would depend on how long that person who took the lump sum, how long they actually lived. Let's say they took a lump sum, they got impacted by COVID, versus if they had a monthly benefit and had COVID and expired.
Sure.
That's the equation. That's the part you don't know
Right.
after somebody took a lump sum or whether they took a monthly benefit. It's, on average, yes, there's some savings, but we're down to such a small number of people. It really boils down to, what's the lifestyle, what's the health status of that retiree.
Right.
And that could also change at a moment's notice, 6 months, a year, that could be very different.
I can add a number to that. When I mentioned earlier that 7 participants who are currently eligible for unreduced retirement, meaning
We're not hearing you.
is this better?
Yes, sir.
Okay. Something about my computer, got to get right square on it, I guess. So as I was saying, of the 7 people that I said that of the 14 total actives currently eligible to retire with an unreduced benefit, their lump sums, an estimate, is a little bit more than half of the current assets.
Of those 14 that could go right now.
Yeah. So so those 7 people there, if they took a lump sum, and this is really measured as of the valuation date, so it could be a little bit more today. Those lump sums were about 1.6 million compared to the assets that were right at 3 million. So that just kind of illustrates, the need for cash.
Sure. Because if all 7 went at one time,
Yeah.
we're going to bottom out. Okay.
But again, you lose their liability. Their liability's gone
That's
too.
true. True. That's true.
So yeah.
Hey, I apologize. This is Bo. If I may interject, my daughter's sweet 16 party is at 5, and so some of this discussion. If y'all don't mind me, just go ahead and jumping in and go through some of the numbers. I can be brief. I'm sorry, I didn't realize we'd be pushing this part to the end.
Certainly.
Is that okay?
Yes, sir.
Absolutely. Sweet 16.
Okay.
Yeah.
Yeah, it's not much of a party with COVID, but typically she's at her mom's house, so I get her at 5, and so I've got to have some plans for her. So, well, thank you for taking time and good conversation with the gentleman from GRS that always put good numbers together. Fortunately, the market in 2019, going back to pre-COVID, was robust for the plan, nearly up 14%, which certainly helped the plan. You do get into some law of diminishing returns anytime you taking into consideration a closed plan. And so if you think about the concept of a closed plan, people pay in while they're working, and then retire, they no longer pay in. And then in a perfect world, everybody would be no longer paying into the plan. It's the peak, and then everyone's taking from the plan, and the last dollar goes to the last person standing. Mathematically, it just doesn't work out that way due to inflation, changes in mortality tables, et cetera. But speaking of COVID and what it's done to the markets, and really what we're projecting going forward. If Tyrone, do you have that presentation in front of them? Sorry, I had to jump off the camera and onto a different device.
I apologize. Can everyone see the Tapers presentation? Okay.
Okay, fantastic. So I'm gonna go to page 4, and it says state of the market at the top, and then it has just a lot of data. And so really, what this page does, is if you focus your attention to all the green areas on the left column, there's been a lot of talk, and I've got another chart in here that says, what the market's been doing. There's kind of the market's been bifurcated really into pandemic beneficiaries and the rest of the market. And so those pandemic beneficiaries have been things like what we're utilizing now, Zoom, Amazon, people doing obviously less in-store shopping. And I can promise you how it's impacted you in your community. It's tenfold in places like Manhattan, where, until recently has just been a ghost town, and our colleagues there and our work fellows that work out of our Manhattan office just give us some pretty grim stories of the state of things. But if you look at the kind of the second subset there, it says U.S. equity cap performance. And what you'll notice is growth and value. So you've got large cap growth, large cap value, mid cap growth, mid cap value, small cap growth, small cap value. All the value names are red, and red in a big way. That means they were negative year to date through 9/30. That's 11.5% from large cap and all the way down to 21.5% for large cap. So, in a normal world, we have a very diversified portfolio. And the reason you have that, because you never know which one of these categories are going to be the leader, and you never know which one of these categories is going to be the winner. And so you do have a diversified portfolio that has exposures to most of these caps and styles. If you look at large cap growth up 24.33%, and you go over to, let's go, Tyrone, to slide 5, the next page. You can look at really what some large cap performance have done. And so looking at the lower left hand column, the lower left square on page 5, you see the S&P 500, which are your largest companies in the world. And you have it dissected, if you will, going back to Jan 1 to the end of the third quarter. And so the dark blue line that shows 42.65 is the cumulative return of the FANG stocks. And the FANG stocks are Facebook, Apple, Amazon, Microsoft, Google. Those 5 stocks have returned 42.65 if you took those as one basket together. The remaining portions of the S&P 500, I would say it's 495, but it's actually 500. There's 505 names in the S&P 500, are actually down on average, the rest of that basket, 1.78%. And so when you don't own or have very large allocations to just those FANG stocks, so the rest of the market's been pretty mediocre. And I think the biggest, issue with today's environment from an investable standpoint is the market has been very different than the underlying economy. And so you've got what I would say very positive signals from the market given through monetary and fiscal stimulus. 10% of GDP thus far has been contributed into fiscal stimulus, which is a huge number. And then the Federal Reserve has taken unprecedented action going back to March of cutting interest rates to zero really over the weekend, and then committing capital to numerous asset classes, including fallen angel corporate bonds, which are bonds that have become junk due to the crisis. And so all of those have contributed to this expectation that the market should be driven higher, although, again, it's very concentrated. So I hope, if anything, that graph shows you where the market gains have been really concentrated. What sold off during this time has been the large banks. JP Morgan, largest bank in the U.S., down 30% for the year. Oil and gas down 50, 60% for the year because there's lack of transportation. People aren't commuting into work. People aren't jumping on airlines. That's just one of what I would call kind of a 3-legged stool that's bad news for energy right now. The others being glut of supply and some other factors of pushing into large pension funds trying to get out of fossil fuels into more green type names. And so those 3 factors have affected that. What we've seen in the last couple of days after the election, almost a day after the election, was some vaccine news. And so what you're seeing take place between the first vaccine news of the Pfizer yesterday with Moderna and today is a rotation of, hey, vaccine's good news. We're going to rotate, the market's going to rotate out of names that benefited the most from the pandemic and go into these value names. And so you are seeing some flows into value. You are seeing some returns, value outperforming growth. And, just for kind of a re-education, the value names are always tend to be more heavily tilted in pension or retirement portfolios. And the reason for that is value tends to be your banks, your energy, some of so companies that distribute dividends to the plan, to you for owning them, right? The growth names are going to be these tech names where they don't pay you a dividend, but they reinvest all that capital back into the company, therefore pushing earnings a little bit higher. And so when you're looking at things such as page 6, which really shows the yield curve, the dotted line on the yield curve was a healthy, normal-looking yield curve going back to December 13, albeit we had really low interest rates on the front end of the curve. But the further you moved out, you got paid more to take on duration risk. And if you look at the dark blue line, you don't get paid more to take on any risk. You take on unnecessary risk to pay more. And so having these value names, these banks that are paying you 3% dividends, are now paying you double what you could get in a 30-year U.S. Treasury bond. And no one wants to be in their right mind locked into a 30-year U.S. Treasury bond at 1.46%. And so, having these value names, what they take a little bit of hit on the surface from some price decline, they're still providing needed income into a pension fund that has money flowing out every single month to meet those obligations. And so it's nice to see some of this rotation occurring back into value. There's still, left to be seen what is kind of the new future, if you will, going forward. And what I would define as that is, how permanent is work remote going to be? And I think that, I look at it as an optionality degree. And I think when you're looking at the major metropolitan areas, exclusive maybe to the East Coast, where there's extreme commutes to work, I think you're going to see a race of the large employers extend this work remote possibility to have a little bit more forward guidance, meaning 2 days a week is only want you into the office. The rest of the time you can be there. And because if they don't do it, their competitors going to do it. And if anything, I think people that I've spoken with that were just kind of convinced, being born and raised New Yorkers, have told themselves that they love the hour commute each way on the train because they get to catch up on email, have really realized now what a stinker that was to believe. I'm having breakfast with my kids for the first time during the week ever. I'm home for dinner for the first time ever. And so I think you're seeing a really shift in the way the working environment happens in the East Coast. And so I do think some of these names like Zoom, et cetera, will be around for a while and continue to do well. It's probably just not plausible that they've had a 400% gain in 2020. So again, we want to be invested in value for two reasons. One, they're typically are more blue chip names, meaning they don't have a lot of oscillation with the market being up and down. Mind you, this was a pandemic and something different that the economy wasn't experiencing. And then two, which, you want that stableness into a pension fund, especially a closed one. And two, you want that income that it produces. We're just having kind of the perfect storm of it being a pandemic and being having the capabilities that we didn't have 20 years ago to be able to make this work from home successful, and to be able to have the Amazon bring you a package every day, be able to order your groceries through some type of provider or what have you. So we'll continue to monitor that shift in the portfolio, but I like the way that we're positioned for it now. Looking at page 7, just kind of quickly, you can see what really happened. I mean, 08, 09, you all remember interest rates were very low, same as they were today as far as getting like a 1-year CD. And then in 2015, the Federal Reserve started hiking rates, getting us back to this kind of normal range or quasi-defined normal range, before precipitously dropping off in 2020 due to extreme measures of the pandemic to really do two things. One, make borrowing easier and less expensive, but two, to force for lack of a better word, force investors into higher equity allocations, being that they don't want to sit earning low interest rates. But, kind of what we've done, if you look at the right chart on page 7, you see that low rates have now really become kind of the norm. And that's a very expanded graph of long-term government investments. And if you look at, we all like to go back and talk about where rates were in the 80s and the high mortgages and during our lifetime, that was normal. And what's occurred really in 08 beyond has not been normal. But looking at it at a broader lens and stepping back, you see that the anomaly was really the interest rate spike that occurred when Paul Volcker instituted some floating interest rates. And so, we're probably going to be into this normal range bound trade for a while of having low interest rates. And so, the Fed has told us they want to keep interest rates low. One thing they cannot control is the back end of the curve. So the 10-year and the 30-year, if you go back to that line graph, that's usually driven off of inflation expectations. And we will have at some point in time some inflationary expectations to address. You can't just, we get a second stimulus if it's the same amount, and who knows what it will be. But if it's the same amount, you're talking 20% of GDP before you even get into the president-elect's administration's desire for a massive infrastructure package. And so, there are going to be some inflationary pressures that'll push rates higher again. But for right now, they're contained. And I say for right now, I'd say the next 3 years. And so that's, macro overview of the markets. And so, let's talk about, I think we can go to page 13 without going through line items here. And I can show you what you were as of, this is pretty current, November 16th. Through November 16th, the plan was up 3.76. That number's found on page 9, but we'll keep the attention on page 13. 3.76%. Again, that's a combination, as you can see, of this pie chart. So this puts, instead of going line item by line item, that puts it in a picture for you. Growth to value. And so, value has been a big portion of the portfolio, 16.32%. That's where the challenge has been through most of the year until recently. It's a matter of time before value starts winning the day again and pushing forward. You cannot have, to reiterate, a portfolio that just doesn't pay you dividends and income. And you can't have a portfolio full of growth that runs a much higher standard deviation, meaning a much higher variance of positive and negative returns for a pension fund. Looking large cap versus mid cap on value, mid cap has been historically a pretty stable spot to be in. And the reason for that is the best mid cap companies, right? The best mid cap companies matriculate up to become a large cap company. And so you kind of get good winning companies coming through that space. And so the same would be saying that if you were a small cap company and your market cap moved to mid cap territory, that's a good thing. And so mid cap really catches everything good coming out of small, right? And then the best ones continue to rise. And so we like being kind of allocated to the mid cap space right now in value. Plus they tend to pay you a little bit more handsome of a dividend than the large S&P 500 names. And then, rounding out, what does all that equity mean for you? It's about 42.34% of the portfolio. With closed pension plans, we typically don't get much more aggressive than that on an equity allocation, because as the gentleman from GRS would tell you, if you had a year where you were 60% equity and the market had a 10% down year, and we were down obviously over 35% at one point in time, not the plan, but the markets this year. If you had that type of move, you have to then take what your payout rate is and add that to that negative number. So if you lost 10% and you're paying out 6%, you really lost 16% that year, right? And so negative numbers are twice as impactful to closed pension funds than positive numbers are good. And so when my job is, identifying investments and building a model that doesn't just look to place short-term gyrations in the market. It's to build over market cycles. And we're currently just in a market cycle, because when you lower those bandwidths on a risk reward basis, the risk reward measurement doesn't pay off to be more aggressive for when that negative year pops up. That negative year takes out 3 of your positive years. And so you're right where you should be on an equity allocation. You're going to see other plans across the country lower their discount rate from the actuary. And that is solely based off of a handful of firms that really lead the way in capital market assumptions, right? And so they are prognosticating what they think each of the slices of the pie, and more specifically, even, value and growth down to the capitalization, what they're going to earn over the next cycle, right? Over the next 10 years. And when they have those numbers, then they plug that in based on your current allocation, and it spits out what it would think the plan would earn over the next 10 years. And then that drives where that discount rate is. So, I can tell you 2 things. No one projected you'd make 14% thereabouts in 2019, and no one projected a pandemic in 2020. And so, you need those as a guidepost, and you need those as ways to tell you when the money is. And because if you were to run out of money, your pensioners and your citizens, if they had to come together and pay a tax to fund the plan, would ask, what the heck was everybody doing? How didn't we put some math together and forecast that? So it's very important work they would do. I would not get caught up in the minutia of changing that discount rate number all the time. And what I mean about that is if some extraordinary event were to occur, the reason why they look at it as a 10-year average, because if you were to change that every year, it'd be impossible for you to project out anything, because you'd be having, at this case, $1 million swings on the discount rate, every single year, which is more than your earnings and your loss potential. So, $1 million swing on a $3 million plan shows you how impactful changing that number means, right? And so nothing else happened in the plan. You didn't lose any more money. You didn't make any more money. You didn't have any, crazy extraordinary events, or the city didn't kick in what they were supposed to kick in. You changed the discount rate, and you had $1 million swing on the liability of a $3 million asset plan. And so, again, you use those guideposts and what these gentlemen are forecasting out, because you want everything you can possibly put in the file, especially when you're going to ask for more money. But again, I would keep in mind that the forecasting capital market assumptions, if it was an easy game, we'd all be retired.
True.
And Bo, in my humble opinion, if Amazon would pay a dividend, we would all be in much better shape. But anyway.
Yeah, probably so.
All right. Any questions for Mr. Brister?
And I'm available anytime. If anyone has questions post this meeting, or anytime inter meeting, or heard something from someone, from a pensioner who's asking you the question, please feel free to call me anytime.
Thank you, Bo.
Thank you.
All right. Thank you very much.
Thank you, Bo.
Thanks.
Real quickly, guys, excuse my tardiness for being real late here. I was on the phone with some attorneys, so I was not able to get away from them. But I have reviewed the presentation, and it looks like we're certainly, moving in the right direction thus far.
Kenny, one thing we addressed that Director Peavy and I addressed with Tyronda is we have the possibility, even though the budget has been approved,
yes,
2021, Terry and I feel we might need to make a resolution to revisit that budget.
yes,
So we can reallocate some more funds to this Tapers program for 2021.
Okay, fair enough.
Start increasing it incrementally. I don't know.
Right, after that.
Where they suggested our 100,000 needs to go up another 300,000. And Dr. Haskins, but I know that's hard to do at one time, but we just from seeing the figures and when the assets are are going to be depleted. I think it's
Right.
going to behoove us to really take this serious, because last year, 2019, the stock market bumper year, and then here we've got COVID and crash, and I just don't think any type of stability is maybe going to be in the foreseeable future. So we have to be stable on our contribution increases
Sure.
for the Tapers plan. And that's where we're
Right.
coming from after seeing the figures.
We'd
Okay.
rather the city be putting in an extra 100 or 2 a year as opposed to taking the possibility of perhaps a $1 to $2 million hit in
Yeah.
2028 or 2035, depending on
Yeah.
how long we kick it down the road.
Yeah. I mean,
The
that
city
makes
doesn't want to
sense.
hit that multi-million dollar hit because we're going to fund it no matter what.
Sure,
It's just a
sure.
matter of, do we fund it incrementally for the next 10 to 15 years instead of just
Or do we
waiting for
wait
the
to pay a
inevitable?
balloon payment?
Exactly, exactly.
Yeah.
So we both make the recommendation that we revisit this 2021 budget to address
Fair
this.
enough. Yeah. I mean, we've got time to do that.
Thanks.
Linda and Terry, I appreciate very much myself, y'all wanting to take another look at that.
You're welcome, Debbie.
You are welcome, Debbie, definitely.
You've been good
That's-
employees. Mhm.
That's what we're here for.
Mhm.
We're here to help
That's
the city.
scary.
But here's the thing, our job is to benefit the city, but who is our city? Our city are the employees
Right.
like y'all.
Sure.
And that's our job to take care of you guys. You've dedicated your careers to the city. We got to take care of you now.
Right.
Thank you.
Mhm.
If there's ever a need for us to be up at the city for further discussions, we're happy to do that.
Okay.
Thank you, Tammy.
Appreciate it.
Thanks, guys.
Absolutely.
Thanks. I appreciate you guys being here. Thank you.
Hopefully
Danny
next time
and
we're in
Tom-
person.
Danny and Tom and Lindsay, it was nice to meet you. We appreciate all three of you being on today. And
Absolutely.
all of our committee members, we appreciate your service immensely. And Director Peavy and Teeters, you will be missed.
Yeah, that's for
Will
sure.
be missed.
Thank you, really.
If there's not any other business,
You guys have made it easy to work.
That's true. I've enjoyed it.
thank you. Well, if there's not any other business, if I can get a motion to adjourn.
Motion to adjourn.
Second.
Okay.
All right.
Thanks,
Y'all
guys.
have a great
Thanks, Tara.
Bye.
Bye.
Thank you, everybody. Thank you, everybody.
Lindsay,
Bye, y'all.
Rhonda. Rhonda.
Bye. It was nice meeting you.